The Iran war is hurting your business in margins, supply chains, and your market. In this video, you're going to see 3 things how to save your business from the war. First, how this war is quietly shifting money from the Gulf towards Greater China, especially Hong Kong. Second, what that shift means for your capital allocation and supply chains. Third, a simple checklist you can take straight into your next board or investment committee meeting. You'll walk away with a clear, practical way to talk about Gulf to Greater China risk and opportunity with your board and your team. The Iran war has done 2 things at the same time. First, it has raised the cost of risk in the Gulf. Oil prices have spiked. Shipping through and around the Strait of Hormuz has become more expensive and more uncertain, and insurance costs have gone up. Second, it has forced wealthy families, funds, and corporates in the Middle East to ask a hard question. How do we protect ourselves from these costs? Do we really want this much of our capital, our headquarters, and our political risk concentrated in one region that is now an active war zone? Because of that, many of them are now looking for a second home base for money, for listings, and for family office structures. At the same time, Beijing and Hong Kong are sending the opposite message. We are the harbor of stability. We give you deep markets, rule-based systems, and direct access to 1.4 billion consumers. So this is not just an oil story. It is a story about where capital feels safe when the Middle East is on fire. Let's talk about Hong Kong, because this is the core of your decision. Since the Iran war started, family offices and ultra-rich investors from the Middle East have been looking more seriously at Hong Kong again. Hong Kong has rolled out new tax breaks and incentives for family offices. These vehicles can hold global assets, property, funds, private credit, even gold and crypto, in a familiar common law environment. For a Gulf family that wants a plan B outside the war zone, Hong Kong now looks like a plug-and-play second base. They are looking for stability, liquidity, and options. Hong Kong offers all 3. It's not just private wealth. Hong Kong's role as capital market for China means that when investors want China exposure, but also global governance and disclosure standards, they often come to HKEX. Since the conflict escalated, local media and data have pointed to rising interest from Middle East investors in Hong Kong listings and debt markets, and a pickup in trading volumes as money rotates away from pure Gulf risk and into Asia. As a Western executive, you do not need to copy that behavior, but you must understand that this same financial plumbing is what allows your company to move capital quickly between the Gulf, China, and global markets when the world is unstable. Now zoom out from Hong Kong to Greater China. While the Iran war dominates headlines, Beijing has been hosting global CEOs and selling one big message. China is a stable economic force in an unsafe world. At the latest China Development Forum and similar events, senior leaders told executives from companies like Apple, Siemens, and Volkswagen that China offers policy continuity, infrastructure, and scale, even as other regions face war and fragmentation. At the same time, China has been working for years to diversify oil imports and build energy stockpiles so it is not fully hostage to the Strait of Hormuz. For foreign investors, there are signs of renewed interest in entering or re-entering China, especially in high-tech, consumer, and manufacturing sectors. So here's the core strategic question for you. Do you treat China as a shock absorber for Middle East risk, or as another geopolitical risk center that you also need to hedge? There is no one-size-fits-all answer, but ignoring the capital and supply chain shift from Gulf to Greater China is no longer an option. To make this practical, let's apply a simple MAPS lens so you can talk about this with your board. M stands for market. How much of your future revenue could reasonably come from China and the wider Asia region compared to the Gulf? If the answer is a lot, then your capital strategy should reflect that reality. A stands for access. Do you have trusted on-the-ground access to Hong Kong and mainland institutions, banks, regulators, key partners, or are you still operating through third-hand relationships from London or New York? P stands for policies. Do you truly understand the tax, sanctions, and regulatory rules that apply when you move capital from the Gulf into Hong Kong and China, and then back into your home market? S stands for supply chain and networks. If shipping through the Gulf is disrupted for 6 months, which of your supply chains break first? And do you already have China or Asia-based alternatives mapped and ready? You can take these 4 questions and turn them into a single slide for your next risk or strategy meeting. To close, let me give you 3 direct questions you can take straight to your board or investment committee. First, concentration risk. Are we over-concentrated in Gulf hubs for capital, logistics, and leadership? And do we have a realistic plan B that includes Hong Kong and mainland China? Second, capital routing. If we needed to move capital quickly out of a conflict zone, do we have pre-approved banking, legal, and governance structures in Hong Kong or Greater China that can receive it? Third, opportunity cost. While we are focused on the war, what opportunities in Greater China are our competitors quietly locking in energy, green tech, manufacturing, and consumer markets? If you want structured help to answer those questions using a STAR plus MAPS framework for your specific company in Canada, the UK, Europe, or Australia, that is exactly what I do. Use the link in the description if you want a tailor-made Gulf to Greater China strategy for your board.